most startup businesses don't need a CFO. But what they do need is for the numbers to tell a story. Now, what I mean by that is making sure that you understand how to present your numbers and making sure that you feel comfortable with your numbers and making sure that those numbers tell the same emotional, passionate story that you tell when you're pitching for funding. Because that's where things fall over. People believe in you, they believe in the total market, they believe in the opportunity, and then they look at numbers and they look at legals that sit behind it and they go, but these things don't make sense. So, if the clicker works, if you can move me on. My background is I'm a chartered accountant. I worked at Deloitte for a lot of my career. So Deloitte in Cambridge, I spent most of my career working with funders like Amadeus Capital, like Cambridge Enterprise, and also all of their portfolio companies. What's also relevant is I was a CFO in industry as well. That's unusual for most advisor accountants. So I'm personally really interested in renewables. I helped a renewables business build a whole bunch of solar farms in the east of England. We went from 10 million to 100 million turnover in less than 24 months. It was completely mental, and I bear all of the pains and scars from that period. So the things we're going to cover today are, we'll touch a bit on what Arish talked about in terms of runway and burn, mostly talking about modelling and the challenges some of you might have in modelling. We'll talk about making the numbers useful, so talking about making them tell a story, and looking at my team, turning them into things that mean something to you, that help you make decisions, that allow you to run a better business. And then the stealthy last bit was fundamentally, I'm going to talk about pitfalls, but it's actually, I'm going to talk about tax. I'm going to try and bring this to life by some real stories. This photo was sent to me by one of our clients, a founder of a software business in Manchester, and his text whilst he was near this situation, he was on a retreat, he said, well, it'll be fine because my runway is 12 months. Now, I had the unfortunate situation of needing to text him back and say, no, I think it's 7. That was a big problem. This is about confidence in your numbers, but also in really understanding what else is going on. He was making some really simple assumptions, but fundamentally he didn't understand the whole position about his financial model, which is where the next slide comes in. 3 is the magic number. What I mean by this is people do financial modelling where fundamentally it's a cash flow statement. You're talking about cash I've got now, and you're talking about ins and outs. Unfortunately, the people who are funders will want to understand what the profit and loss looks like, what the balance sheet looks like, and what the cash flow looks like. They are connected things, and the best financial models include all of those 3 things. Now, why are they different? Anybody in the room who's running a subscription business, your subscription that you receive up front, that income needs spreading over 12 months. If you're paying up front for something that you need to fund and build the business, that needs prepaying. Now, sorry, for anybody who's good at their accounting, you probably already get all this, or you've got a good accountant who's supporting you to do it. But this is where we see things go wrong, is fundamentally the P&L is not equal to the cash flow, and not understanding what's going on in the balance sheet. So not understanding, as another example, I have a business that provides software to the oil and gas industry. Those people are horrendous at paying that customer. So that business typically invoices their customers and they don't pay for 90 days, 120 days, 150 days. That's a really, really important variable in their financial model that, on the face of it, that business wouldn't make sense. Next slide, please. So, as I say, I'm going to speed through it. Here's 6 things that I think need to be in your financial model. Revenue logic. So Arish touched on this. Like really understanding what's driving revenue. So is it The top of the funnel is number of introductions. The next line of that is what conversion has gone to proposals. The next line of that is what proportion of people accept those proposals, or average spend per order on an online store, or whatever the right metrics are. That's what really matters. The outcome, again, as Arish said, and I apologize, I'm going to say a lot of things that he said. The financial model is only right at the point at which you build it. It will be immediately wrong afterwards, because some of those variables will change. But making those variables based on the data you have today and building them into the financial model to say, in 6 months we think the average spend will have gone up by 10%, which does this to turnover, which does this to cash or profit. That's really sensible logic. Just saying revenue will go up because we've been around for so long and we think more people will come into, that stuff doesn't stack up. Cost drivers. So lots of the businesses I deal with are people-driven fundamentally. So they're software and they are driven by how big is the tech team, what is the product development pipeline, and what people do they need to unlock those product development milestones. So what are those cost drivers that matter most to your business model? Is it people? Is it something around gross margin? Is it any of those different variables? Hiring impact is something we see go wrong really easily. People's fundraising ask might well be quite prepared to say, we need to hire these people. Okay, but what do they achieve? Do they unlock the development of that part of the product, which then unlocks that part of the revenue cycle? That sort of structured thinking around what the funding ask is and how it impacts the hiring and how it impacts the revenue logic. These are all really connected parts of what that financial model should look like. And then what are the key ratios? So either the ratios that drive revenue or costs, or the ratios that are the outcomes. Lots and lots of businesses have a revenue lag between what you see as being the indicators of good success, members, engagement, any of these early indicators. So what are those key ratios that you're going to add into the model that then help explain why investment now equals this product being released then equals this sort of revenue at that point? Understanding those steps in the financial model makes lots and lots of sense. Next slide, please. Hope doesn't count as a strategy. Next slide. So the things that I've heard people say are, this is what we're going to do in terms of how these people will come on board in their financial model, but with no expectation around any hiring costs. So I literally mean recruitment fees. We're going to engage all of these people by our social media and they're going to want to join us. That sounds lovely. As an investor, they're going to say, I do not believe that, and I'd much rather you prove that to me afterwards in savings than ignore something like that. Having growth in there without having proved what the cost of customer acquisition, CAC. I've got a giveaway at the end on a whole bunch of horrible terms that we like to use, acronyms, so hopefully that will break some of that down for you. But it's a really common thing to just draw this lovely hockey stick graph of customer engagement, sales, new stores opening, whatever it is, without some real connection between what you're doing that drives that sort of engagement. And just this point around raise with no clear impact of what the funding does. We see working capital missed out of the fundraise requirement, missed really obviously and often. So understanding whether or not your customers will pay you in some sort of sensible terms, whether or not you need to commit to buy product materially up front and how much that's going to cost, building that into what the fundraising ask is really fundamental. Okay, so as I say, this is a real whistle-stop tour. next part, making numbers useful. As I said, the numbers need to tell a story. Now, if any of you are using your accounting packages and just printing the P&L that it gives you, please stop it. Nobody thinks about the expenses that you spend in alphabetical order. I know that's how it gives it to you. That is not good. Okay? Good management information should say things like how you think about the business. I need to spend this much money developing the product. I need to spend this much money on these people in this part of the business, and this much money on these people doing the operations of the business, and this much money on these people doing the selling of the product. Your accounting package will not come with those things set up out of the box, but please make sure it does. Right? So I've put here, split your reporting by function. So most typically for me, I will split it between research and development, the costs that might create me a tax credit later, I'll talk about that in a bit, sales and marketing, because when you're calculating ratios like customer acquisition cost or ROI, I was talking to somebody earlier about ROI on direct marketing, having those in the right bucket means it's just a formula that says that divided by that, rather than, oh, how many of these people related to that cost? Don't do that. Make the numbers do the work for you. And general and admin, like who is a non-scalable cost as part of the business model and who needs to scale. So if you know you're going to need to add customer success people, split out customer success people. If you know you need some more direct sales people and they're going to be commission driven, having those people split in the model and having the ratio split in the model will make loads of sense to people. It also allows you to make decisions. So what we increasingly see with people who've fundraised is actually the ability to be really dynamic with your spend. So saying you need X to spend on marketing, but you're going to A/B test the pricing of it in the first 3 months and do some at that price and some at that price, and this is how you're going to fund it. That is excellent detail in terms of really understanding what the sales and marketing spend might be. And the reason I say it's really useful to get the model in that sort of functional way and the reporting in that functional way is because then you can do some really nice variances. Again, most of the accounting packages you can buy off the shelf for tens of pounds a month, Xero and QuickBooks and Sage and all the others, will allow the ability to put your budget, your forecast in there. Yeah, so don't be doing that manually yourself. Make sure the system is telling you, oh, I spent more than I thought on that thing. And then write down why and write down what you're going to do about it. That is exactly what investors will want to see. Aris said the model is only right once. He's entirely right. The budget, the forecast is then. But you'll be revisiting it every month as you go along and making revisions to it. And then being able to prove that you've made those decisions based on the data you had at that point. KPIs really matter. So the P&L in it, the balance sheet, what impact that is, what's looking like a cash, but also what are these metrics that forward tell you and investors, if you've got investors, whether or not you're achieving success. So things like, what's the total top of pipeline look like? What's the cadence of potential customers going from stage A to stage B to stage C? What does that look like? How does that funnel narrow down? Things like, again, this is a bit jargony, but number of users or number of logos, logos being customer names, customer acquisition cost, lifetime value of a sale. So lots of those acronyms and KPIs, which again, hopefully are in a little freebie at the end. But the questions are, whether or not to prove whether or not you understand your numbers, how long will your cash last? What happens if you miss your revenue target? And what metric proves it's working? Those are the things in my mind that will make an investor feel like you're an investable project. Yeah. Knowing right now, as your business stays exactly as it is, how long have you got? What happens if some of those assumed monies in don't appear? What will you do differently? And what tells you whether or not it is or isn't working? So what are the common pitfalls? I'm going to talk about tax in here, which is why I've hidden it behind this lovely wavy slide. But I'll talk about other pitfalls first. We've covered a lot of these, but what is it funding? So I read a really interesting article on LinkedIn yesterday by an investment manager, investment director in Cambridge, and she said the number of the times where she's going through this beautiful pitch deck, says we're going to do this and we're going to do this, and at the front it said we want to raise $500,000, and when she's added up in the pitch, it adds up to a different number, or it doesn't factor in things like working capital is 90% out of 100. So I think being really, really clear on that ask and why it unlocks those things in the model, and knowing that is as important as understanding your metrics of how the model works longer term. Again, flipping about with a spreadsheet. So you might find that you Google, I want to do a forecast, and you find like some sort of online tool that wants to do that for you. Those are cool, but you'll find every single investor says, that's lovely, can I have a spreadsheet? So just build it in a spreadsheet first. It's also a lot easier to go, I've copied those things here, and now I'm going to take 40% off my optimistic numbers and work out what happens. And on the optimistic one, I'm going to add some on. And having those and knowing what drives them, that is really... So you'll have your perfect business plan, a bit like the question earlier. You'll have the budget, but knowing what the upside case is and what the downside case is are really, really important. And then this linking back throughout the model, understanding what drives it. Those are the common pitfalls there. And then working capital cycle. So if anybody hasn't seen that before, this working capital cycle, it's literally for accountants, you account for the number of days in it. So how long does it take customers to pay you? How much credit can you get when you pay your suppliers? And then how long do you need to sit on stock if you have any stock? That is a calculation. And knowing that stuff and knowing how long, what you've effectively got to fund, because fundamentally your small businesses, probably speaking to larger businesses, they unfortunately won't be your funders. They're going to take advantage of you. So knowing that up front is really helpful. Now let's talk about tax in the last couple of minutes. So go for it. I'm going to talk about two things, and as I say, it's quite a whistle stop, so please have a chat with me, Corinne or Jodine afterwards. So VAT, I'm going to start from the bottom. So if you haven't yet registered for VAT, you can do that early, and you can recover VAT from stuff you've spent already. So if your accountant hasn't told you that, you can go and get, let's say you've been running for 6 months, you haven't yet registered for VAT, you haven't even broken the threshold, but maybe you want to get the VAT on that cost back now, you can do that. For 6 months in relation to services and for years in relation to products. Keep documents, but please don't keep them in a shoebox. There is so much cheap tech out there to just snap as you go and take photos of things. If your most early stage businesses are spending and therefore getting a refund, and guess what, HMRC will come and ask and say, can I have a look at those really big receipts where we gave you £10,000 back, or you want to get £10,000 back. And then R&D, I know it probably has been mentioned before in some of these sessions, but so if anybody doesn't know, if you are building a business that specifically has created some sort of technical advance in what you're doing, so definitely over there, medical device business, you will be doing something in this. If you're spending £100,000 or £10,000, you can get a cash tax credit back from HMRC for doing that sort of stuff. So we were talking about building a product earlier, like if there is nothing available on the market that currently does that, then definitely you could look and say that is an advance in what you're building, and therefore you should get some sort of cash tax credit. It's complex, so don't just wing it. Go and speak to an advisor. And the reason I say that is because in the last 5 years it was abused as a system. People were like saying, I've developed a new croissant. And unfortunately some rogue advisors were out there going, yeah, we can get that through. It created over £500 million worth of abuse of that system. So as a result, again, expect HMRC to query it, therefore make sure you've spoken to somebody who's technically able to help. Those are my key tax things that can go wrong. VAT can be a real surprise, especially when you start selling things, and R&D tax credits can be an under-noticed bit of funding. Here is a QR code. You will be able to download a copy of a financial model from that, and if anybody doesn't get this now, we can get it sent to you afterwards. It's also got a glossary of terms, so all of those horrible acronyms that we've thrown at you really quickly, we explain what they are. And then it also, I think, links to my business's website, which is Scalable Finance Teams. Thanks.
Amazing.